Hello everybody, today I'm simply going to explain an IPO. But before we get into it, why do a company do an IPO? Well, it is to seek external financing. It can either be done by debt or equity. And in this case, for the IPO, it is equity that's being offered to the public. Now regarding IPO, it stands for Initial Public Offering. And what's special about it is that it is the first time equity is being offered to the general public. Now, the whole process is usually handled by an investment bank. And if we're going to explain the whole process, it starts with the due diligence. This is usually done by an accounting firm that looks at the numbers in the company. They make an evaluation of the company, and they look that everything is in order. And then the second step in the IPO process is to bring in a legal opinion from a law firm. Now, as for the third step, once the due diligence is done, all the numbers are okay, an evaluation has been made, a legal opinion has been brought in, everything is fine, there is nothing fishy, a filing will be made to the SEC. And when the IPO has been approved, that's when the process starts for the investment bank to start filling its order books. They have all this equity that they need to sell. They need to bring in finances to the company doing the IPO, because why do they do this IPO? Well, they need to bring in money. Take for example, maybe it's a hamburger restaurant that's doing a great job selling a lot of burgers. They're very popular and they want to expand. They need more money so they can open more stores and chains and just expand. They need money to buy properties, to expand the supply chain. So that's why they usually offer equity to the public, because it will allow them to expand faster. They have profitable investment project that they need the money for. So all this equity needs to be sold at the price the company was valued to when they looked at the books. So the investment bank call up funds, hedge funds, pension funds, wealthy individuals, and also retail investors get an offer. You may have seen it in your trading platform. Sometimes you get an offer to take part in the IPO. Maybe you want to join the Facebook IPO, you want a part of that equity when it's first offered. Now, is only investing in IPOs a successful investing strategy? Not really, and I will explain why. If the IPO is successful, which it tends to be in most of the cases, due to the firm doing the IPO wanted to be successful and the investment bank wanted to be successful to sell everything, so they tend to underprice. But when they do this, demand is high if the market thinks this is a good deal. And then as a retail investor, you will only get a small part of the equity you signed up to get. So sure, you will make money in that IPO, it will go up, but you will not get the full amount that you signed up for. So in real terms, in dollars and cents, it will be a small gain. However, if you sign up for an IPO that goes bad, there's low demand in the market for this IPO. People do not want to buy this equity. Then you will get assigned the full amount that you asked for. And it will go down. And in real dollars and cents, this will be a relatively larger downturn in the portfolio value than the gain you made when you invested in the successful IPO. So now, even if most IPOs are good, in terms of real dollars, real cents, it averages out at about 0 for this strategy. And with the investment fees, it will be a small loss. This is why you don't see investors use this strategy. It's all supply and demand. This has been IPOs, Simply Explained. Thank you for listening.